All right, let's get right into it. Today, we're going to look past all the simple, flashy numbers and really learn how to size up a trading strategy like a pro. This is all about seeing the full picture, not just that one shiny metric that everybody seems to obsess over.
So let me start by throwing a question at you, one that really messes with a lot of traders. You find a strategy, and it boasts this incredible 80% win rate. You're thinking, this has to be a money printing machine, right? But then you trade it for a while, and the account is just slowly bleeding out. How on earth is that possible? Well, the answer is actually pretty simple, but it's also incredibly important. Trusting just one number is like trying to understand an entire movie by looking at a single random screenshot. It just doesn't work. To really get what a strategy is about, you have to look at it from a bunch of different angles. And that's exactly what we're going to do.
So let's start with the big one, the most famous, and honestly, the most dangerous metric of them all. Welcome to what I call the win rate trap. It feels great, but oh man, can it lead you astray? You see, win rate is just about how often you're right. You make 100 trades, 80 of them make money. Boom, 80% win rate. And psychologically, that feels fantastic. Who doesn't love being right most of the time? But it tells you absolutely nothing about how much money you made on those wins. And, way more importantly, how much you lost on those other 20 trades. Okay, so if win rate isn't the whole story, then what is? Let's move on to the numbers that actually show us the real engine of a strategy's profitability. This is where we stop hoping and start looking for a real mathematical edge. That actual verifiable advantage your strategy has in the market. And for that, I want you to meet the profit factor. This one is a personal favorite of mine because it's just so direct. You take all the money from your winning trades and you divide it by all the money from your losing trades. The question it answers is brutally simple. For every single dollar you lose, how many dollars do you actually make back? Now, anything over 1.0 means you're technically profitable, but what the pros are really looking for is a number over 2.0. Why? Because a profit factor of 2 or higher shows you've got a really solid edge. It gives you a huge buffer for all those real-world costs, like commissions and slippage, which means your strategy is much more likely to work in the real world, not just in a spreadsheet. So, if profit factor is the big picture view, then expected value gets right down to the nitty-gritty. It's brilliant, really. It takes how often you win and lose, and it combines that with the average size of your wins and losses. And what you get is one powerful number that tells you, on average, how much you can expect to make or lose every single time you click the button. If that number's positive, you've got an edge, period. Okay, great. So we figured out the strategy can actually make money. Fantastic. But now for the really tough question. Can you actually survive the ride? We have to measure the pain that comes with the inevitable losing streaks. And this right here is your worst case scenario metric, your maximum drawdown. It measures the biggest single drop your account has ever suffered from its highest point. And this is a massive test because a drawdown that's too big doesn't just threaten to wipe you out financially, it's also the number one reason people give up on a perfectly good strategy, usually right before it turns around. And this chart gives you a perfect visual of how it works. So let's say your portfolio hits a brand new peak, and then a string of losses kicks in. That distance from the very top to the absolute bottom before you recover and hit a new peak, that percentage, that is your maximum drawdown. That's the pain you had to live through to get the returns. Now, let's look at something a little more subtle. The ulcer index. What a great name, right? It doesn't just care about how deep that drawdown was. It also cares about how long you were stuck at the bottom. I mean, a quick shark drop might be scary, but you get over it. But being underwater for months and months, that grinds you down. The ulcer index captures that total, drawn-out pain. All right, so we know it makes money, and we know how painful the journey can be. The next question is obvious. Are the returns actually worth the risk? It's kind of like measuring a car's fuel efficiency, We want the most miles per gallon, the most return for the least amount of risk. So first, you've got the classic, the Sharpe ratio. It measures your return per unit of risk. But it's got this funny little quirk. It treats all volatility as risk. The good kind, when your account spikes up, and the bad kind, when it drops. But wait a minute, we like the good kind. That's why a lot of traders prefer the Sortino ratio. It's just smarter. It only penalizes you for the nasty downside volatility, the stuff that actually costs you money. And finally, let's talk about the bounce back.
Let's talk about resilience with the recovery factor. I love this metric because it's so simple. You just take your total net profit and divide it by your worst drawdown ever. A really high number here is amazing. It tells you the strategy doesn't just survive its worst moments, it comes roaring back to push into new profit territory. It's maybe the ultimate sign of a robust strategy. Phew! Okay, we've been through a lot. We've talked profitability, we've talked pain, we've talked efficiency. So, how do we pull this all together? Well, let's build ourselves the ultimate trader's dashboard, a simple checklist you can use on any strategy you come across.
So here it is, your 4-point check. Step 1, check for profitability. Is there a real edge here? Look at your profit factor and your expected value. Step 2, assess the risk. Can you actually live through this? Check that max drawdown and the ulcer index. Step 3, evaluate efficiency. Are you getting paid enough for the risk? That's where your Sharpe or Sortino ratio and your recovery factor come in. And finally, step 4, which brings it all home, understand the strategy's DNA. How does that win rate play with the average size of your wins and losses?
And please remember, this dashboard is an amazing start, but you still have to think about the real world. Things like transaction costs, your commissions, your slippage, which is just that tiny price difference when you execute a trade. Those can absolutely destroy a good strategy. You got to ask, is it consistent? Does it work when the market is trending and when it's choppy? And finally, how does it fit with everything else you're doing? So I'm going to leave you with this question to chew on. After all this, which single, simple metric are you finally going to stop putting all of your faith in? Because building a truly professional trading approach, well, it all starts by asking better questions and demanding much more complete answers.